Okay, this video covers the different cash flow categories that exist. So first of all, let's take a look at what categories we've defined, okay? So accounting standards define three different categories of cash flow. And first, let's remember that the purpose of cash flow is to explain why the cash balance changes. So at the beginning of the year, we had a cash balance, and at the end of the year, the cash balance has changed. And investors in the company want to know, why did the cash balance go from what it was at the beginning of the year to what it is at the end of the year, okay? And that's what the purpose of the cash flow statement is. And the really useful part of the cash flow statement is the division between the different activities that a company engages in. So a company engages in operating activities, that's buying and selling inventory or services. They engage in investing activities, that's investing in long-lived assets or divesting from, so selling long-lived assets. And there are financing cash flows, so getting investment from equity or debt investors, or distributing money out to debt or equity investors. Okay, those are financing activities. So we'll break our total cash flow down into these three activities. And just to learn a little bit more about the division between these activities, we'll go through an example, and this is just a made-up example of a company that goes from beginning to end, okay? So we're going to start this company at time 0, and we're going to talk about the cash flows of this company. So at time 0, the owners, the new owners, provide $100 of capital to the business. So in terms of the business, this is a cash inflow of $100. And this is an equity investment from owners, right? This is owners. So it's an equity investment. And so it'll be a financing cash flow, and it's an inflow of $100. So it'll show up on the cash flow statement as positive $100 financing cash flow. In period 1, the company is going to take that $100, and they're going to invest in productive assets. They're going to invest 80 of it into property and equipment. And that property and equipment will eventually be used to produce and sell inventory. But right now, we're just in period 1, all we're doing is investing in that equipment. So when we pay $80 for the equipment, it's a cash outflow. It occurs in period 1. We're investing in a long-lived asset, and so that is an investing cash outflow in period 1. Okay, period 2 is our operating period. We're going to use the property and equipment to produce and sell inventory, and we're going to generate $200 of net cash flow. And when I say net cash flow, I mean $200 represents all of the cash we earn in revenue from our customers, minus all of the cash that we pay to suppliers and other operating costs, okay? So this is just a net operating cash flow, and it's in period 2. And it's positive, okay? So in period 2, we generated positive operating cash flow. And it's operating because we were selling inventory and we were generating revenue from customers. And that's an operating activity. So that'll be a positive $200 cash inflow from operating activities. Okay, so for whatever reason in period 3, we determined that our inventory has gone out of style and our property and equipment is not being put to good use anymore. So it makes sense to wind down the business. So rather than try to keep this company alive, we're just going to wind down the business, okay? We're going to sell the property and equipment to someone else who might be able to use it. We'll sell it at its salvage value, which is $20 here, and we'll sell this long-lived asset. So the person, we put it on Craigslist, the person comes to get it, they hand us a $20 bill. That's a cash inflow to our company, and it's us divesting from our long-lived assets. And so that's a $20 cash inflow from investing activities. And finally, in period 4, the company has $240, at least I hope. This adds up to 240, so take 100 minus 80 plus 200 plus 20, and the company has $240 in its bank account. So it needs to distribute that back to its owners because it's winding down its operations. So what it will do is just pay it out of the bank account and pay it into its owners' pockets. So this will be a $240 cash outflow. It's a distribution from the company to investors, to our financiers. And so this is a financing cash outflow from the company. And so there's the pyramid, right? There is the pyramid of a business cycle where we got an investment, we invested in assets, we operated and earned cash, we sold our assets, and we distributed the remaining cash to investors. And I hope this helps kind of clarify the different categories of cash flow.